In this portfolio update, I'm going to talk about the stocks I've sold, why I'm selling them, how my Freetrade dividend growth portfolio has performed versus that of the market in the last week, and the importance of investing in bonds and when you should buy them. Firstly, I'd like to briefly add that over the last week, we've gained over like 60 subscribers, and it really means a lot that I'm able to positively add value to your investing journeys. With that in mind, I'm going to increase the duration and hopefully more content in the portfolio updates and try and give as much back as possible. I hope you enjoy the longer style videos. So how has the portfolio performed this week? Well, the markets have seen quite a considerable rally. In fact, I think we saw something like a 5% increase from Tuesday till Thursday. And then obviously Friday comes along and then it all drops again. See, I'm not too bothered about the capital gains of my portfolio. I would actually rather my capital gains were lower. So if I saw negative values, it means I've got more opportunities to buy into the stocks, get them at a better discount, higher potential yield, and then hold them for the long term. And I think that this rally was caused to the partial reopening of the lockdown in Europe, and therefore subsequently the travel sectors had seen a massive boost as some of them were able to offer services. And I actually bought into more of Redrow and Diageo this week. Diageo wasn't exactly at an amazing price, but I had to do it for certain reasons, from transferring from another investment, which I'll talk about later. And Redrow, again, wasn't the highest value, but in the next 3 to 5 years, I see the stock being 2 or 3 times more than it currently is. So why would I miss out on this value now? However, if the market drops further, and it might do, because Friday did see a substantial drop of about 5%, so we literally had knocked out all of the gains we'd had. If the market does drop again, I'm definitely going to invest some of my cash that is outside of the portfolio. Currently I've got a balance of about 60% in stocks, 40% cash. I'll move that in and then I'll buy more Redrow very likely. And I think that the house builders are extremely undervalued, and I want to expose more of my portfolio to that. Overall this week, I think the market has gone up by about 1%, and I'm quite happy with the portfolio's performance. It's gone up by about 1.5%. And this is mainly thanks due to Rio Tinto and Unilever. Unilever has seen an actual rally for once, and since owning this stock for the last month and a half, I've not actually seen this stock rally. And it is nice to see. So they've gone up about 6% and held it. Diageo, on the other hand, has dropped by the same amount. Rio Tinto, however, is keeping its gains and it's staying up 13% in the portfolio. We also saw the insurers rally this week. They were considerable gainers and then it got knocked away, but even then I'm in the green for them for once, which I seem to mention quite often. Shell, however, has obviously, as the energy sector is not performing too well, and in the last day I think it lost about 6% in value. And currently there's not much cash left inside the portfolio, but as I said earlier, there is cash on the outside and I will deposit more. I'm going to continue cost averaging into the market, whether it rises or loses, and that will be £125 each week. And if you've enjoyed this video so far, please consider subscribing for weekly portfolio updates and monthly stock picks for the FTSE 100 and 250 to watch or to buy. Thank you. So for the juicy bit of the video, the bit you probably clicked for, right? So which stocks did I sell out of my portfolio and why? So firstly, I sold Carnival Cruises. This was a very small position, so I'm not going to allocate too much time to it. However, I don't think they'll be resuming their dividend payments for the next 2 to 3 years. And I think it's going to take a very, very long time to recover what they once had. They've had to dilute their share pool in order to raise capital. They have a lot of debts against them now, such as the bonds that they had provided against their cruise ships. Yes, they have seen a considerable rise in the amount of people booking cruise trips in April next year, but I don't think that's enough. I think they are going to struggle. I don't think they'll go bankrupt, and I do think it'll be a great investment, but I'm looking for higher gains in the medium term. I think that I can pick stocks that will casually, slowly grow their dividend, and I will still be getting an income instead of just waiting for Carnival to start paying their dividend again. And since I had one whole share, I walked away with about £1 in profit. So please, what a round of applause. See, Warren Buffett would be proud of that trading. That's sarcasm, by the way. It's kind of stupid of me. BP is a stock I've mentioned in the past, and actually very recently on my dividend watch list. And in fact, if you've seen that video, you'll probably know why I've sold out of them. Currently their yield is unsustainable and their payout ratio is something like minus 254%, which is uncalculatable because they are losing so much money right now. I see it very, very, very likely that they're going to cut their dividend when they announce it, and I think that will be around July, so about a month's time. And I figured, you know what, I'm in the green with this investment. I'm just going to sell out now. I've already earned a dividend in the last month from them. I'll get that payment and leave it as that. However, we did have a comment suggesting that they were actually planning to scrip dividends, which would have meant that they would have paid their dividends with more shares, but I simply just didn't see that to be enough value. And in fact, I already had too much energy exposure in my portfolio. Shell has taken up so much, and I don't see them recovering for a few years yet, so I think I want to lower my exposure a bit. I've got that, that's my play, and over the long term that will probably outperform my current investments, but I'll have that on the side. I want to focus on my other investments and really outperform and do the best I can with them. And so in order to balance out my portfolio, I want to raise my allocations of my remaining stocks to around the similar level of Shell, so that there's an even balance between stocks, so that if one of them goes bankrupt per se and the stock goes to zero, at least then I don't lose a significant portion of my portfolio, which in the case of Shell, I think I'd lose about 16% of my overall portfolio's value if they went to zero, which is very unlikely. These investments are still good investments. I've just sold out of them because I'm changing up my investing strategy somewhat, and I wanted to lower the amount of stocks in my portfolio in order to maximize the gains. So I didn't need to diversify as much as I did. As long as I've got one in each major sector, I'm happy. Now you might be really confused to see that, hang on, your portfolio is missing Britvic. You were a large advocate of BVIC in the past. Why have you sold out of them? They have a license to use Pepsi's products and sell them and distribute them in the UK. They have a great market in Brazil where they are growing their soft drinks and expanding outwards. Hell, they're even headquartered in a neighbouring town. So why did you sell them? Well, in reality, I had to look at the stocks in my portfolio, and I already had a beverage stock, which was Diageo. And now I thought about it like this. I figured that the soft drinks industry is a lot easier to get into than the alcohol industry. So I think already there, Britvic has a smaller moat. It's also worth thinking that currently there's a lot of soft drinks in the world. And I think that there's so much that it's hard to get through that and expand and grow. For instance, you've got Coca-Cola's dominance, Pepsi's dominance, and other certain various drink brands. So I think it would be very difficult for Britvic to grow outside of the UK. And I figured, well, Diageo is also in the beverage industry, and currently they do only sell alcoholic products as far as I know. But what if in the future they decided, right, we're going to take an expansion, diversify our own company and start investing in soft drinks? I think they would be in a much better position, could outcompete Britvic, and then have their own soft drink brand that they could probably establish with their already high market dominance in the alcohol industry. And I don't see the demand for alcohol dropping off in the long term. Also, yes, Diageo has a lower dividend yield than Britvic, but Britvic has actually suspended their dividend. On Wednesday they had announced this, and it doesn't follow the companies I invest in. I invest in dividend growth companies, companies that are either paying the most of a dividend they can or continuously growing their dividend, so that on a chart it looks like a nice staircase that slowly gets steeper as you get further up. And so what I did is I sold out of Britvic, and I actually sold it at a high. I should have sold it on the day they suspended their dividend because they were at like a recent high, for instance, but I sold it the day after and I'd only lost about 2%, but I'd gained like 5%, so overall I did leave in the green. But what I did is, because I sold at a high, I also invested in at a high and bought into Diageo because I felt that my money would be better off in that part of the portfolio. I figured I needed more exposure to Diageo, and I think that they've got excellent growth opportunities in the future. Yes, they're probably sitting on fair value at this point, but I do think in the future, or in the next 3 to 5 years, it's going to be more than fair value. I think possibly in the next 5 years they could probably even double their share price. So that's why I think it's such good value at the moment. So, and now to the main topic of the video, the importance of bonds and investing, or should you own them in your portfolio? So it's very, very likely that you've seen or heard of the research that over the long term, a period of 5 or more years, stocks outperform bonds in pretty much every situation. And the longer you hold equities, in fact, the lower risk they actually are. And it kind of negates the impact and usefulness of bonds. And bonds even offer a lower dividend yield. It's not technically a dividend, but it offers a lower yield than that of most dividend stocks. So why would you buy into bonds if they don't offer higher capital growth or higher dividends. And in fact, in recent news, about a week ago, the Bank of England offered short-term 3-year bonds at a negative interest rate of 0.003%, which sounds ridiculous to a retail investor. Like, why would we buy this? But simply for the bigger, more institutional investing, they have so much money, they don't know where to put it. And so they can't just chuck it in a bank account. So that is actually a good offering for them. And that's why they were bought up. However, bonds provide you with a security amongst things. If you don't have that high of a risk tolerance, you simply can't stomach or handle the fact that your portfolio has dropped at 20%, then you want more bonds in your portfolio. There's a fly that's just gone into the room. Leave. Swear, if you open a window and it's near to nighttime, like the whole cast of A Bug's Life just comes flying through, it's ridiculous. Then bonds can help you reduce the overall volatility of your portfolio, and you'll be so much more comfortable in terms of large panic sell-offs such as the recent pandemic crisis, as they typically hold their value over the long term and can be used as a hedge in some sorts. When the market drops, equities are sold, people are panicking, they might run towards bonds. So as stocks go down, bonds might increase. But you are a high risk investor, right? And you want the best returns possible. So you should go 100% equities, right? Well, maybe not. The fact that bonds can be used as a hedge, and as I said, if they're at a high and stocks are at a low, you could cash out certain amounts of your bonds, sell that, then reinvest them in the stocks at a low, and continuously do this as the market is downtrending. This, compounded with the fact that you might be adding more of your own money from the sidelines, and cost averaging into the market, means that once the downturn has finished, and you've seen a significant rally or we're back into a bull market, you would have seen a great amount of return, and in fact your portfolio would be much higher than before the crash. But should you own bonds at all times? And probably not, because as I said, over the long term they will get outperformed by equities. So you need to price into the market whether you should be high risk or low risk. If we're in a market crash, we've already seen a significant drop from the large market indices in your investments, then there's no real need to go conservative now. Because obviously, how much more risk can there potentially be if the market's already dropped so far? So maybe at this point you want to maximize your returns and therefore go high risk, especially when thinking about the UK economy. The UK economy, with the looming Brexit negotiations and the fact they haven't delayed it, perhaps this is going to lead to another further downturn, and perhaps we'll come out of a bad deal in Brexit. So you would want to maximize your risk as much as possible, because what's the worst that could happen? It's already at a low, right? But if, for instance, Brexit goes well and all of our stocks rally, and in fact you think they're quite overvalued, then you might want to buy into bonds. At least then you don't have to invest your cash that you're putting into your portfolio each time, but then you can just cost average into some bonds, hold them over the long term when you think a recession is looming or a crash is incoming, and then you can slowly cash out parts of it, rebalance your overall portfolio, and get greater returns with your equities. And eventually the market will have a downturn and a recession. We have seen a downturn. Perhaps there might not be a recession for the next 10 years, but this is standard economic cycles, and it is very likely in the future that there will be another recession. And with bond exchange traded funds, they've got such high liquidity that you could buy into them and effectively have your money in a high interest savings account inside your stocks and shares ISA portfolio. So it's a win-win, right? And there's also another advantage. Perhaps something tragic happens, you lose your job during a recession, you had an emergency fund because you did save up some money and you've been watching, for instance, Dave Ramsey, and you're on baby steps, but your emergency fund hasn't covered long enough. Yes, it really helped you in 2 months period, but you still can't find a job. At that point, you might have to liquidate or sell out of some of your longer term assets, such as your stocks in your portfolio. However, if there's bonds in your portfolio or bond ETFs, you'll be able to sell out of them, not impact your overall long-term returns, and use your bonds as an emergency fund. So it's there as a form of security to allow you to be more comfortable, and then also sell them if there is an emergency without losing out on, because if the market has crashed and you're in a recession, you can't get another job, you'll be selling your assets at likely half the price of what they would be, and so you would be losing even more money, whereas bonds, they will hold their value or even go up. So therefore you would be getting the best with your emergency fund. So personally, I'm going to buy long-term yield bonds, ETFs, when the market has recovered and I believe it to be strongly overvalued. However, this is largely dependent, as I said, on the UK economy and the outcome of Brexit, as it might be a time to maximise your risk and bonds might not be such a great idea for now. However, in the future, we might see negative yield curves again, and then it'll be a great time to invest in bonds. Make sure to stay tuned, as in the next portfolio update, I'm going to be talking about monthly dividends, how to achieve this in your portfolio, and how much you would need to earn a certain dividend income per year. So if you have any questions about investing or finance, please leave them below and I'll talk about them in the next video update. Thank you for watching. I'm Osborne Foreman. Have a great day.